Hello and welcome to another episode of the I Love Annuities podcast. I'm your host, Jeremiah Conger. Today, we will be discussing the fixed indexed annuities and continuing in our Annuities 101 segment. But today, we're going to be discussing how lifetime income riders work within fixed indexed annuities and showing you how they can be a great tool to use in retirement, both leading up to retirement as well as after retirement. We're going to show you exactly how this unique feature found in a fixed indexed annuity can help you meet your goals for income in retirement. So that's going to lead us right into understanding what exactly are we talking about. Well, we're talking about a fixed indexed annuity. Those of you who have tuned in to our previous podcast episodes, you were probably interested in fixed indexed annuities. And our first episode was all about the growth side of fixed indexed annuities and how they work, how they protect your assets from market volatility, and how they grow your income, your accumulation value very simply by using an index strategy, but also shielding it from market volatility because you're not exposed to any losses. Well, today we're going to be discussing the lifetime income component found in fixed indexed annuities, why they're helpful, why people use them, and why most fixed indexed annuities are sold with this lifetime income rider attached. So it comes down to understanding the lifetime income feature. So when you're getting into a fixed indexed annuity, majority of the products available on the market today offer what is called a lifetime income rider. A lifetime income rider is essentially a feature or an option that you can add to the annuity contract. And the nice thing about it is that it's adding another component of guarantees in the contract for that fixed indexed annuity. So when you enter a fixed indexed annuity on the growth side, you have the guarantees of principal protection that regardless of market fluctuations and different indexes that you may be tied to, depending on the performance, regardless if they have a negative performance for the year or 2 years or whatever your period your term is, your guarantees on the principal are that you cannot have any losses. So if you put $100,000 in and the index performs poorly and has a 10% loss, your $100,000 stays right where it is and resets every year or every 2 years, depending on the crediting strategy that you have. On the lifetime income side, you have guarantees on what is called a roll-up rate. So the way that I like to explain a fixed indexed annuity that has a lifetime income rider is picture a T-chart. So you've got your T-chart, and on the left-hand side of that T-chart, you have your growth side, which is your investment that you started with, and it's going to be credited based on your performance of the index and the strategy that you have signed up for. And then on the right-hand side of that T-chart, you have your income base or income benefit base. And they're two separate accounts, essentially. One is growing based on index performance. And on the right-hand side, the income value or the income benefit base is growing two ways. The first way is the guarantees. In these annuities with lifetime income riders, they will state in a contractual guarantee that regardless of how the growth side performs, your income side is going to grow at a guaranteed rate. This rate is called a roll-up rate. Now, the roll-up rates in today's day and age at the time of this recording can be anywhere from 3 or 4% minimum to as high as 7 or 8%. Now, keep in mind, this roll-up rate, while essentially it is being used to factor and determine how much lifetime income is guaranteed, it is not a value that you could cash out. So let's say you sign up for a fixed indexed annuity and you are in it for 5 years and you decide, hey, things have changed, I want to go ahead and cash out. You cannot cash out the income benefit base. You can only cash out the principal and accumulation side. So these roll-up rates are basically made up interest rates. I mean, they are being used to determine how much income you're guaranteed, but you cannot cash them out. So they're not a growth vehicle, if you will. They're not, the income benefit base is solely used to factor how much guaranteed lifetime income you will receive once you activate it. So when you have these roll-up rates, the nice thing about them is, let's say, it's 7%. Well, if you decide that you're going to defer this income annuity, maybe you're 60 years old and you're retiring at 67, well, you can defer the income for 7 years. Now, in most fixed indexed annuities, they're going to give you the highest amount, whether it be the growth side has grown higher or the guaranteed roll-up in the income benefit base is higher. Whichever of the two is higher, that's the income value that is factored to determine how much lifetime income you'll receive. The other factors that are used to determine how much lifetime income you'll receive in each annuity, and each annuity company and rider, the features are different. They're not all created equal. And that's where it comes, looking and finding an expert that understands these products and has the tools to help you find and identify which annuity is best for you. It all comes down to who's going to pay the highest amount of income. So anyways, the factors that are used to determine that are the income base, so however much that value is grown to, or if it's the accumulation value, whichever's higher, how old you are at the time that you're activating it. So as you age each year, and some of them increase this payout factor every year. As you get older, it'll be a slightly higher rate. Maybe it's 10 basis points. So for example, if in the contract or the illustration, it'll say, if you turn this on at 65, it might pay out 5%. But if you turn it on at 66, it might pay out 5.1%. If you turn it on at 67, it might pay out 5.2%. So some of the lifetime income riders will grow that payout rate, that payout factor, or what's also called a distribution rate. It'll pay, those will increase, those amounts will increase either based on each calendar year that you age, or some of the products will have a step-up rate where every 5 years that payout rate might go up. Some might even do every 10 years. But where we typically see, or what's common in these products, is every year there's an increase on that payout rate based on your age at the time of activating the income. But the other common way is every 5 years. So if you're 60, it might pay out 5%, but as soon as you turn 65, it'll pay out 5.5%. If you activated it at 63, it still only pays 5% because you're still in that 5-year bracket. So the key thing here when you're looking and shopping for income annuities or fixed indexed annuities with lifetime income riders is you want to know a few things. You want to know who's going to pay out the most. That's ultimately the bottom line. And how are they factoring that? So the payout rate is based on your age. And there's also a feature called a bonus where these products will give you a bonus for investing in the product. But the bonus only counts towards that income value most of the time, especially if it's a lifetime income structured fixed indexed annuity. So let's say you put in 100,000, these carriers will offer a premium bonus, anywhere from 5%, 10%. I've seen them as high as 22%. There's an annuity on the market. It's been one of the fastest and number one selling annuities in this space for a long time. But during certain years, they'll offer a 22% premium bonus. Now, if you're talking to an agent about an annuity and they come to you and they say, hey, I think this is the one you should buy because it has a 22% bonus, and that's what they're selling you on, and that's all they lead with and finish with, I would probably advise you to run. Most likely that isn't the best annuity on the market. It may have the highest bonus, but the bonus is just one factor that's used to determine who's going to ultimately pay the highest amount of income guaranteed for life. So 9 times out of 10, when we're advising someone on a lifetime income annuity or a lifetime income rider and a fixed indexed annuity, 9 times out of 10, the highest guaranteed lifetime payout amount is not the annuity with the highest bonus. So keep that in mind. If someone's saying, hey, this is the best annuity on the market because it gives you a bonus on your money, that's not true. There's no free lunch here. There's only 100 pennies in a dollar. So if they're building these bonuses, they're pulling from other benefits in the contract. And the number one thing that counts is the bottom line. Who's going to pay the highest amount guaranteed for life? Now, the other thing that can determine the payout rate or how much is being paid on a guaranteed basis is if you're structuring this rider or this lifetime income annuity for single life or joint life. Obviously, if you structure it for joint or 2 lives, you and your spouse, they're not going to pay out as much as they would on a single life. So it's very important to note, if they're structuring it for joint, that you may be giving up some income, but keep in mind you're also covering both lives, and that's ultimately the goal, is to make sure that both spouses are covered in the event one of us should pass away early. So in addition to that, there are some lifetime income riders that will offer what is called an increasing income feature. This is something that is fairly new. It's been around a handful of years as an option. The increasing income feature, basically what that part of the rider states is you're giving up a little bit of the guaranteed portion. So when you're looking at an increasing option, your guaranteed income amount will be less than if you just went with the full guaranteed amount with no increasing opportunity. And then what it states is that depending on how the accumulation value does in the annuity, so the performance of the index and the crediting strategy, if that value lifts and continues to go up, then they'll credit whatever the gains were. They'll credit a portion of that, or sometimes all of the gains, towards the income amount. And it allows you to have increasing income, which is great if you're trying to use this as a way to hedge for inflation. But in our philosophy, you're kind of still playing the what if game. And when you're looking at annuities, at least in our philosophy, you should be looking at them as a guarantee. Like, what will they pay me no matter what happens? Worst possible scenario. What can I count on regardless of what happens with the market? And that's how we feel that annuities, including these lifetime income riders on fixed indexed annuities, should be used. Now, if you're looking at using this as a bond alternative, and we'll get into that in future episodes, then maybe if you want to add that lifetime income component, some of these increasing income annuities offer this lifetime income rider as a included option. There's no fee for it, but you're kind of still playing the game, if you will. And we feel that when you're looking at an annuity for lifetime income, you should be counting on the guarantees and not the what ifs. So that leads me into the fee portion of lifetime income riders. Typically, this is very simple. The rider fees are usually between 75 basis points and 1.5%. The max is 2%, but majority of the highest offerings in the marketplace today are typically between 1 and 1.25 or 1.5%. So the way that works is, again, go back to your T chart. You have your accumulation value, which is your initial starting investment, plus any index growth and credits. And then you have your income benefit base on the right-hand side of that T chart. The fee that's associated with the lifetime income rider is charged against the accumulation value. So when you get your illustration, you'll see on the hypothetical part of the illustration, which is showing the potential opportunities of growth from the index crediting method, you'll see every annual year, every biannual, every 2 years, you'll see maybe if there was index growth on the accumulation value minus any rider fee, and then the net amount after that formula is what's credited to the accumulation value. So again, the rider fees are 1 to 1.5% commonly, and they're charged against the accumulation value. So In years that you do not have any index growth, maybe the market was down, you still are going to incur that rider fee, and it will be charged against the accumulation value. Now, a lot of people think annuities are highly feed. That's the only fee that's typically found in a fixed indexed annuity. And again, it's 75 basis points to 1.5%. The highest that we see is 2%, but very seldomly do we do any business with the highest ones. So keep that in mind. Now, who should think about buying a lifetime income rider in a fixed indexed annuity? Why is this something to consider? Well, the people that we typically would advise on purchasing one of these are people that are between the ages of 55 and 70, but commonly it's people that have not retired and they're in what we call the retirement red zone. So if you're within 10 years of retirement, let's say you're 55, you're going to retire at 65, we would recommend taking a look at putting a portion of your overall retirement portfolio into a fixed indexed annuity and having a lifetime income rider added over that 10-year period of time, and deferring that income stream with the potential to turn it on when you retire at age 65. Now, why? Why would we do that? Well, one of the most critical things that can happen to somebody's retirement portfolio when they're in that retirement red zone, again, within 10 years of their retirement date, the most critical thing that can happen is a recession, or even worse, a bear market for majority of those 10 years. And so if that happens and your money and your values go down, well, now we have to take a look at either waiting for the markets to rebound, which we know back in 2008, it took 3 years for the markets to come back to where they were post or prior to 2007. And you're losing time when you do that. So what we look at is using the fixed indexed annuity as a bond replacement. So if you have $1 million, maybe considering 400 or 500 or even 600,000 at the most, and putting that into a fixed indexed annuity with a lifetime income rider. And the reason for that is if you look at the bond markets today, and we'll talk about this in future episodes, but interest rates are in the dumps. They're absolutely in the pits, and you can't count on bonds or bond funds to shield your assets from volatility while also counting on those bonds to provide enough yield for you to sustain an income in retirement. Now, why the fixed indexed annuity is ideal for this is because you're doing a couple things. When you put that 40 or 50% of your portfolio into the fixed indexed annuity, the first and foremost thing that you're doing is you're shielding half of your overall portfolio from market risk. So if the markets ever go down 20, 30%, you know that half of your portfolio was shielded from that loss. And the principal protection and the guarantees of that contract, it allows you to get a little bit more sleep at night, knowing that regardless if the market drops, you've shielded a large portion of your nest egg that can be used for future income purposes down the road. In addition, the fixed indexed annuity and the contract, and depending on the product you're in, will allow you to participate in market upside performance while shielding you from all of the downside. So we typically see the growth rates in these annuities anywhere from 4 to 6%, and don't hold me to that. Obviously, markets can change, but on average, when we look at the performances of these, they perform just like a bond would, and actually have outperformed bonds over the last 40 years. In addition to that, God forbid if the market doesn't perform at all, it doesn't get you anywhere close to that 4 to 6%. Maybe you have negative performance for a majority of those last 10 years before you retire. Well, inside that fixed indexed annuity, the other contractual guarantee is on that lifetime income rider. We know that depending on the annuity and the rider, that we've been growing that income benefit base anywhere from 5 to 7% every single year, regardless of what the market does. So, and that's a compounded growth. So 5 to 7% a year compounded over 10 years. If it's 7%, we're practically doubling your investment on the income benefit base side that can be used to factor in for lifetime income, we're doubling that after deferring it for 10 years. And so what it does is it gives you peace of mind that regardless of what happens in the market, we've been growing the benefit base at a guaranteed rate that can be used to turn on and calculate the lifetime income stream at year 10 or year 11 when you turn it on. So gives a lot of peace of mind there. And then the last part of why we would recommend it is this gives you, doing this strategy. Let's say you buy the lifetime income rider in the fixed indexed annuity, you defer it for 10 years, and you get to that 10-year mark and things have changed. Maybe interest rates have improved. Maybe your overall goals or what have you have changed. Well, you have options now. You can cash out and take out the accumulation value, or you can cash out some of it after that period of time and leave a little bit more in there or a little bit left in the lifetime income side to turn on for income. But you have options, and that's the nice thing. Now, included also in majority of these income riders and these fixed indexed annuities, you do still have liquidity in the annuity itself. If you need access to any of the money in the account, you can access up to 10% per year with no penalty. Now, obviously, if you're younger than 59 and a half, they're still going, and it's qualified dollars that we're talking about in these in this annuity, then obviously you would still be accountable for that IRS penalty of early withdrawal. But after 59 and a half, any qualified dollars that you withdraw up to 10% in the annuity, there's no penalty incurred whatsoever. So you still have options, you have flexibility, and you have guarantees of both principal protection and lifetime income. And it just gives you more, it gives you a lot better situation at the end, potentially, because you didn't lose. You know that you've gained a guaranteed amount on the lifetime income side, and you most likely have gotten some upside on the portion that was shielded from market risk. So does that mean that every fixed indexed annuity needs a lifetime income rider? No, it doesn't mean that at all. It just depends on your individual situation. But we see a lot of upside by adding that feature. Now, let's look at it in a different light. If you're maybe 70 years of age and you're thinking about looking at these lifetime income riders, well, where we've typically find these to still be a viable solution and something to consider is when we have someone 70 years of age or older. Again, age is a big determining factor in how much payout is guaranteed, how much lifetime income is guaranteed. We'll shop these against the single premium immediate annuities to figure who's going to give us the highest amount of guaranteed income. Well, a fixed indexed annuity with a lifetime income rider is also a deferred income annuity. So if you're considering waiting at least 13 months until the income stream is activated, 9 times out of 10, the lifetime income rider in the fixed indexed annuity will offer a higher contractual guaranteed lifetime income amount than the traditional immediate income annuity would. And in addition to that, you're not annuitizing the investment or the premium that you're putting into the account when you put it into the fixed indexed annuity. When you go and buy an immediate income annuity, you're annuitizing it most of the time, meaning you're giving them $100,000. You lost all liquidity now in control of the money, and they're going to guarantee that income stream for the rest of your life. But in a fixed indexed annuity, you still have some control here. Let's say you defer it 1 year and you turn the income on year 2. Well, you could start receiving income year 2, year 3, year 4. While if you have a good fixed indexed annuity, one that's competitive in the market on the growth side, it's going to retain some accumulation value. So you still have liquidity there, and you have the ability to completely exit that contract, at any time. Even with that surrender charge, you still have liquidity there. Also, majority of these fixed indexed annuities offer what is called a confined care rider or an enhanced benefit rider. And what those are designed for is that if you are a little older and thinking about buying these, which, these insurance companies have developed these products for retirees, both early retiree, pre-retirees, newly retired, and have been retired. So they understand that as you get older, there's going to be a potential need for liquidity in the event of a health event. So if you have a need for long-term care, or you have a terminal illness event, these riders, they're not charged anything. And if you're in the state of Florida, these riders are included, required to be included on every product sold here, so that in the event you're older, you buy this annuity, you turn on income, or you don't turn on income, you're just using it as a growth strategy, and you have a terminal illness, well, you can exit the surrender period with no penalty, even in the middle of the surrender period. So it's a nice feature. It's a lot of peace of mind that you're not signing up for something that you just have to die with and never have access to the money. You're going to be able to use this money and access it penalty free in the event you need it for a health event. So we've talked about lifetime income riders. We've talked about the fees associated. We talked about the guaranteed roll-up rates. We talked about the payout factors and whether it's single or joint. And the next thing we talked about is when you should consider buying them. And that's within that 10-year period before retirement and after retirement is when you should consider them. And if you're just looking to defer the income for at least 13 months, they're usually a better option than an immediate annuity plus the liquidity options that are available. And that leads us to, understanding the role that the annuity plays, the lifetime income rider. And that is, at the end of the day, if you have concerns about relying on the market, being dependent on stock market returns for income, and you're not wanting to take a chance there with, all of your nest egg, the way to get more peace of mind, clarity, confidence, and most importantly, predictability is by using a lifetime income rider or a lifetime income annuity as a way to cover what we call your essential living expenses. If you can get between your Social Security pension, if you're blessed to have one these days, plus guarantees from the lifetime income annuity, if you can cover all of your essential living expenses of retirement by those sources and use the rest of your portfolio for growth, that is where optimizations are created. So again, covering your essential living expenses in retirement, knowing that every month, regardless of market performance, you have your basic core living expenses covered by guaranteed income streams. And then you can strategically place more money in the rest of your money in the market and leave it, set it and forget it, and let it grow. Because as we all know, the market is a long-term play. Over long periods of time, the markets go up and occasionally they go down. But if you're no longer dependent on it for income, think about what it can do for you. Think about what it can do for your peace of mind and sanity in retirement, but also think about what it can do in terms of improving your lifestyle. You know that regardless of what happens, no one can take away your lifetime income, your guaranteed income from Social Security, pensions, and annuities. And so your core foundational life is covered. And then you have nothing but upside potential on the rest of your portfolio. And that's where you can use the money to knock off those bucket list trips and, buy the things that you've dreamt of buying with the gains that come from the markets. That, in our opinion, is how you create optimizations. And we have proven, based on science and math, and we would love to show anybody that's interested, on how adding an income annuity to your overall portfolio in retirement not only will increase your income stream in retirement for the rest of your life, but also provide more investment returns on your growth side of your portfolio because you're not taking money out of it for income. And you can strategically determine when you want to take out money for those bucket list items and purchases and things that you want to do. You can strategically do that now. You don't have to do it. you have flexibility, you have options and peace of mind by doing it this way. So hope you found this helpful today. I think I've covered everything that I had on my notes. If you have any questions, you can visit our website at www.annuityassociation.com. If you're interested in trying to learn more about annuities, you can visit our YouTube channel there. We have all of our information. And if you'd like to talk with us on our website, you can also schedule yourself an appointment. We'd be more than happy to help you. Hope you found this helpful. Hope everybody has a great day. Thank you so much for tuning in. Take care of one another.